Good afternoon, everybody. My name is Howard Cohen. I'm an advisor with Strategies for Wealth. I'll tell you a little bit about myself afterwards. I'm secondary to this conversation. I'm just leading the conversation. We have three great distinguished panelists today, some that I've had the opportunity to meet prior to this, but we all had a great conversation last week. There's Peter, who is online, Suzanne, who is sitting to my right at the end of the table, and Ellen. And I think the best way to start off is by letting everybody introduce themselves before we get involved in the discussion. So I'm going to start off with Suzanne. What I find interesting about this panel is that we have the discussion about managers and manager selection coming from three different perspectives. So Suzanne, if you would start off by introducing yourself.
Sure. Thank you all for being here, and thank you all for online listening. Very quickly, I have been in this business longer than I care to admit, both on the sell side and the buy side. We have our own family office. Well, we have two. We have mine and we have my father's widow, which is separate, but we run them pretty similarly. And then I've been on the hedge fund side for a very, very long time in a number of different roles. So I think I bring a perspective of both the investor and having sat on investment committees, both of an insurance company and an outside family office, our own family office, but also having been the main capital raiser for a number of different funds in the alternative space.
Ellen?
Ellen Baker. I have a company called Baker Aurora, and I started out in investment banking, segued into private clients, coincidentally ended up in the ultra high net worth arena. And so I've catered to them, I've gotten to know them, and ultimately started my own business about 11 years ago. And they come to me and ask me about various investments. And so my manager selection is going to be very different, because I have to pick things. People come to me and ask me to help them do fundraise because they know I have a lot of very interesting connections. So I have to do my due diligence, which is quite onerous. I can go into that a little later. And with in mind that I'm dealing with various families that are interested in alternatives.
And Peter?
Yes, hi everybody. So Marty, thanks for having me back. It's always great to see a lot of friends. Sorry, I'm not in New York today. I'm coming from the sunny skies of Florida. So my background is 30 years on the sell side and buy side, and over the last several years, more on the advisory side to family offices, corporate boards, as well as credit funds. And as I put in the chat with my contact details, our focus is strictly on origination and research of deal flow investments for family offices and for selected institutional investors. We also do some capital raising for those that need it, in particular when we have large deal flow and we need to do syndication. Our focus is primarily on real estate funds, CTA managers, which I'll go into in a lot more detail, particularly with the geopolitical and macroeconomic risk floating around the markets, litigation funding. In the hospitality industry, we focus on, and we also focus on the non-plant-based touching cannabis industry.
Yeah, so the first question I have, and if anybody has any questions along the way, please raise your hand and I will try to recognize you. And Marty comes back, he'll certainly tell me if there's a question from somebody online. Suzanne, as a family office, what do you look for in a manager?
That's a very broad question, obviously. I think the first thing we look at globally is just asset allocation, right? What areas do we feel like we need exposure to? We might not have enough. We might not want to be exposed to. I think integrity is really important. We spend a lot of time thinking about the background, the reputation, the integrity of the manager. We're happy to invest day one. In fact, we like that. We like smaller managers. We like the entrepreneurialism you see there. We like the flexibility, but that requires as you alluded to, an extra level of due diligence. We want to see that the back office is buttoned up, right? And that's a big part of what our outsourced CIO does, because he's got a whole division that does nothing but that. And frankly, it's minutia that I don't want to get involved in. But I think for us, it's best in class. It's what area of the markets we want exposure to that we may or may not have, or want less or more. Integrity and knowing that at least the business side is solid, because we can't 100% know whether the investment side is going to be solid. I mean, ultimately, you're betting on a horse.
Right. So, Ellen, Suzanne just spoke about what they look for in a manager, and it sounds like they do a lot of it internally. So, why does a family office need you and not just do it internally?
I have to go through probably a month or two of onerous due diligence. I mean, I have to review who the auditors are, who the lawyers are. I get background checks. I have to go through subscription agreements, go through the whole 9 yards, every document that they had to file to do their business. I have to catalog that. I have to vouch for it. I have to visit their office, which was difficult during the pandemic, and meet the players. It's a real onerous process. People come to me because they know I can successfully raise money for good quality funds. But I have to be very careful, because I don't want to go through this process. I don't want to put my broker dealers through this process unless I really feel I can be successful. It's particularly a lot of due diligence these days.
So I just want to circle it up. I mean, first of all, our family has the benefit of, we have a Wall Street background, right? My background was Wall Street. My father's background was Wall Street. And by the way, I just want to be clear, I made my own money. My father's widow has his money. So my family office is my family office. But because I come from that background, I know the questions to ask and I know what to do. I think what Ellen is doing is slightly different, because she is asking the questions that many family offices may not know how to ask. That said, and this is no negative on what you're doing, because I think you provide a valuable service, I tend to not want to invest with people who need an Ellen. Because if I'm going through an Ellen and that manager is paying Ellen, it's a different selection process, right? Our OCIO only does deals with people who, if he says, I'm going to bring 10 families to you and I'm going to cut a deal 1 in 10 versus 2 in 20, making up numbers, that gets passed through to us. I'm paying him for the services that he provides. So he's totally neutral. And I think what Ellen's doing is terrific, by the way, I have to say, because a lot of people don't have the resources that we have. But a lot of the larger banks the model doesn't work, right? They're only referring their clients to managers who are willing to pay them. And I think that's something that family offices need to be really conscious of. I think your business is more bespoke.
Well, as Mom was discussing earlier, I lately have been doing a lot of early stage. So you can't find it on the internet. You don't have people that have knowledge of these companies. So I've been dealing with a lot of be it private equity or early stage venture capital of late. And so I have to do all the heavy lifting.
So, Peter, where do you fit in on this particular part of the process?
Right. So for me, there's plenty of consultants that are out there. There's also plenty of databases like Preqin where you could do your own research on managers. And in the current environment today, pandemic, if we go back to the global financial crisis and crisis going back before that, it's always been a tendency, particularly for pension funds, sovereign wealth funds, and family offices, when allocating to a manager, they try to stick with the best in class, best in breed, largest, because it's unlikely they get fired if the largest ones go down. So I am hired by family offices for not the manager allocation, but for simply portfolio recommendations. So we are in the midst of a massive geopolitical risk right now, and it's these exogenous factors where the tail wags the dog, as we saw just last month at the conference here that we were doing. The whole conference was focused on banks and SVB Bank in particular, which nobody was expecting. It just came out of the left field. So for me, I'm trying to look at, when I'm hired by a number of family offices, is where should their allocations be? And so with the geopolitical risk, with the macroeconomic risk that we have, I've been consistently since the beginning of this year recommending CTAs. CTAs are basically just a way to reduce and manage volatility in a portfolio, which is critical in this current environment. It's basically portfolio insurance. And I believe that every family office, ultra high net worth individual, or even mom and pop should have 10 to 20% exposure to CTAs just to manage that volatility. And we saw their success when we had the initial pandemic. I also think, given the current environment, we should be focusing much more, which is Suzanne and my focus, on private credit. Simply, the leverage is not going to be there for the banks for their deals to give significant returns. So there's things, private credit's going to be an excellent thing for the next 12 to 18 months. I also think the hospitality industry continues to do extremely well. So I'm looking forward to allocations collectively there, particularly on the technology side. And then on litigation funding is something that's a non-correlated asset class. So recommending there. So if, from my point of view on the asset management selection, it's really, I'm not focused on the managers. I'm focused on where should your portfolios be allocated. Within that, I can give recommendations, okay? But at least we have a framework at a very top level, and then we can get more granular. And then away from all of that, it's specific origination opportunities. Within that, I try to find ones that have a 5 to 7 year gestation process.
I think there's a question. So
Sure. I guess one of the issues is that you're cognizant of the fact that where your family financial wealth and how you sons. There's an old saying about the food chain and asset management.
Just 1 second, I'll bring you the microphone.
The saying in the food chain of asset management is those that can do.
Can you start from the beginning?
Those that can do, others who can't quite allocate, neither can do neither particularly well consult, and the rest just sell. Follow the alpha, follow the origination, follow where the money is being made, and be very skeptical of how it gets done. I think UAs represent, and everybody here represents, some of the best of breed, but that's a cautionary tale.
So I think that was a statement, not a question. And I will say that Peter gave me an ample opportunity to talk my book. So I do have a day job. I work with another family office that we are relaunching a fund that the partners ran successfully from 1999 to 2013. They wound it down, became a family office, did not see the opportunity in the space. It's lower middle market, special sits, distressed, not for control. I like to say we're suggestivists, not activists. We like to be in a blocking position in a credit. We don't originate. We want to buy public credits. It could be of a public or private company, but we want to take a blocking position in the credit that we think is the fulcrum, and then work with managements to solve their balance sheet problems. And I do believe, whether it's our fund or other funds, given where rates are now, finally, given where the market is now, with hugely overvalued equities, in my opinion. And so in your equity portfolio, I would give advice to family offices. You want to have managers that can really short and really understand what that means, not shorting for hedging, alpha shorts. We don't in our fund, because it's very hard to short credit, and it's certainly very hard to short distressed credit, but we're looking for distressed companies. And if anyone has them, bring them to us, right? Like good businesses, good managements, bad balance sheets, because they can't get it from the banks anymore, as Peter said, right? The world has very drastically changed in the last 4 months. Anecdotally, I have a close childhood friend who left Citigroup as a private banker, went to First Republic. Good for her. She has an 18-month guarantee. She said, when I first got here, I could make a loan in an afternoon. She said, now I can't make any loans. And I can't keep assets on the book, even though First Republic is not in the trouble that the other banks necessarily are. So the worm has turned, as they say. there is finally an opportunity to really make money in credit. I mean, my partners would say if they had known and they've kept the team together the whole time, they'd have a lot more stamps in their passport over the last 10 years with interest rates at zero. But there's going to be huge opportunity in the credit markets, both in private credit and in public credit. And I will also say there's going to be opportunity coming out of very poorly underwritten private credit.
Direct lending.
Well, that's what I'm saying. Direct lending. The direct lending guys, there are really good guys, Ares, Crescent. I mean, I can name them. There are also people that have done very sketchy underwriting and they do not know how to work out these credits. And that is the hen that's going to come home to roost.
Getting back to selection and manager selection and piggybacking on what Suzanne just said, Ellen, when you're working with a family, how much does instinct actually come into play along with the due diligence that you're doing? Instinct of the feeling that you're getting from the companies that you're vetting, the opportunities that you're vetting. And I'll ask that for Peter as well.
Generally, when company comes to me, a fund, and says that they would like to, use my talents to help them with a raise, I have to know lots about them. I have to meet all the players. I said, due diligence is tremendous. I also want to know who else has been involved, maybe as an investor or whatever. Lately, I've been, as I've mentioned, doing funds that were startups. They've come to me a lot of times through their attorney because they get stalled and they really need some hit for their final close. And I help them over the fence. But you have to have instinct. You have to be able to size. It's about people and the way they think and the decisions that they make. It's very important in investing. There used to be cocktail party due diligence. Oh, he's a smart guy. He's investing in Madoff or whatever. They're making a lot of money. Gee, can I get in the deal? What's the goal?
SBF.
It's what?
SBF. Last year.
Oh, right. Yeah. So instinct does play quite a bit. But there's a lot of homework. There's a lot of due diligence that goes beyond being able to make a successful investment presentable and put it on your portfolio.
I don't want to take Peter's thunder, so I'm going to pass it back. But Madoff is like a great example, right? And I'm in a lot of the documentaries and I'm in a lot of the books on Madoff. We never said he was a fraud. But we definitely were very outspoken about saying he wasn't doing what he said he was doing. Mm-hmm. And we did a lot of work around that. And to this day, it blows my mind that people weren't asking the questions that we were asking. Mm-hmm. And my father, who was a Wall Street guy and who always made the family's investments before he passed, he said, I wouldn't touch it with a 10-foot pole. But and in his case, it was instinct. Mm-hmm. In my case, because at that point I was working for an insurance company, you're being offered a resale of a separately managed account, which for insurance companies is a big deal because it saves you a lot on capital charges and whatever. So we wanted to believe. So we saw a red flag. We said, let's just go to the next thing. And we found 20. And that's why, to your point, you have to do the deep work in today's day and age. It's the regulators have made it a little bit easier for us because things are more transparent, but you still have to be willing to do the work.
And the case in that case was 3 guys basically banked him every time there was a capital call.
Are you talking about Fairfield Greenwich and King Street and not King Street, Kingsgate?
Power and Pick Hour and a bunch of other people.
Yeah, but it's, and look, Walter Noel is still wandering around a free man, which is beyond my comprehension. But that's a long, we can have that conversation offline.
The other side of the coin is that there was a chief financial officer of fund of funds who was green because he had was underperformance on his risk free, and I said, well, everybody else did Madoff. Where is it? Sure. Right, and half the people here know.
Yeah, but you know what, Marty, if you did the work, I mean, I sat next to, and we shouldn't get off on a Madoff tangent. But I sat next to a guy at a fund of funds. I was at a conference in Barcelona. And the guy said, the hub to our spoke is Madoff. And I said, let me ask you a question. I said, what businessman, and I'm going to say it, my name is Suzanne Murphy, but I'm a Jew. So let's just be clear. I said, what businessman do you know? And what Jewish businessman do you know who is paying tens of millions of dollars a year to other people? And the answer was because Bertie doesn't want to run a business. And I said, listen, for a tenth of what he's giving out, I'll go run his business. I said, I don't believe it. So there were just too many. It doesn't matter the pressure people were put under. If you had presented the information, you should have given it to your clients.
And Harry Markopolos wasn't around then.
So
Well, he was, but he wasn't as outspoken. But Peter, go ahead. Sorry, I
So
just
Peter,
don't-
I wanted to, if you would comment on instinct, because I find it interesting that that still plays a part in what people do or don't do.
Integrity.
Look, I've been a research analyst for 30 years, and I never stopped doing that when I moved into banking, et cetera. So for me, the big sexy thing over the last several years is ESG. And, going back to the 80s, I've always said ESG is just one of many sets of tools in your tool belt. You look for companies that have all three of those things well managed or have the liquidity available to manage them. So, when we look at managers, et cetera, my job is not looking, as I mentioned, for the granularity of individual managers. I'm looking for deal flow. And that deal flow requires significant due diligence on my part, both financial modeling, corporate governance, et cetera, on each of the individual deals before I present that to a family office or I present that to an institutional investor. So I'm kind of their outsourced research analyst as well as banker. So I'm in the weeds every day with my sleeves rolled up with the teams I'm working with as we do due diligence together throughout the whole process. And once the term sheet is well defined, then after that, we go through the whole underwriting process. So it is a process. And I think the same thing occurs with manager selection. You might know the best managers, but at the end of the day, Suzanne knows this best. What are the credits that they've been successful in? What does the research team look like? What is their expertise? It's a private credit manager. It's a private equity manager. What are the research analyst teams? What are they composed of? How senior are they? Have they lived through cycles to see if those companies, how they fare? If we get into a situation where a company is needing to be restructured, distressed, do they have the talent to do so? Do they have to go out and hire Houlihan Lokey or others to work with them on that? So, that's key, particularly in this environment where we're seeing the economic pressures and in particular on the interest rate pressures. Can the balance sheets of the companies fare that? And do the managers have the research team that has that cyclicality in terms of their experience? And I think that's key.
Ellen, I wanted to ask you, when you're asked to participate in the vetting process, are there sectors that you will not get involved in?
Again, that goes back to instinct. You have to keep your eye on the horizon. I look for things, little nuggets that I think are exciting, cutting edge, that'll obviously do well. That's important. It just goes back to instinct of something that just doesn't feel good, and I won't touch it.
So can you guys talk about like how macro influences you? Because I think Peter probably is the biggest proselytizer of macro, right? And or where you are in the life cycle of innovation. If somebody came to me with a Bitcoin fund 3 months ago and he was charging 2017 fees, right? I'm like, sorry, nobody's doing 3% and 30 anymore, right? So maybe can you guys talk about that?
Well, and I'll let Peter go because you referenced Peter. But what I will say about fees, and as an investor and also someone who works in the industry, I really think the conversation about fees is ridiculous, because if anyone in this room could get into Renaissance's medallion, you would pay $5 and $50 for those returns. I know I would. So I've said to everyone for years, discussion around fees is you get what you pay for. And I give you $1. All I care about is what I get back.
My question is life cycle, where?
No, I understand, but I'm just saying you mentioned 3 and 30, like whatever.
Because we're far along in the life cycle of crypto. That's why I mentioned it.
I don't care if we're early or late. Like I give you $1 and what am I getting back? Like that's all I care about in terms of fees. So I think it's more the broader landscape. But Peter, why don't you start and then I'll chime in.
Look, fees has never been an issue for me. Whether you're talking about 220 or 230 or 1.5, 15. At the end of the day, the most important thing is, again, I look at everything from a bond investor point of view, like you, Suzanne. I come from a credit background. So for me, is the family.
The glass is always half empty for credit investors, just so you know. We're not glass half full people.
No. But I understand that. But the focus is for a family is making sure that the multi-generational wealth is protected. I had the pleasure of being close with the co-chairman of UBS's global private bank. And, before the CS merger, they're managing 1.1 trillion, and that's tripled. That money has basically, the statistic was a third of that's usually gone by the next generation, by the second generation, half, and by the third generation, it's all gone. So it's all about being a bond investor in terms of protecting the principal. And then anything above that is icing on the cake. So you want to make sure, obviously, that the returns that you're getting for the risks that you're taking are obviously commensurate with that. So if you're in an investment grade bond portfolio, you shouldn't be expected to get more than low to mid single digit type of returns. If you're looking at a mezz type of fund, then obviously it should be mezz type of returns. And if it's a credit fund that takes a lot of private equity risk, then it should be 20% plus. So to me, you should be getting more than adequately compensated for the fees that you're getting, and just make sure those fees are commensurate with the risk that they're taking, the funds that you're putting money towards.
And listen, just to close out your question, Marty, I think from a macro perspective, right? Like Wayne Gretzky said, you want to be where the puck's going, but it depends on your risk tolerance. So for example, my father's widow is 72. I'm 55 with a 10-year-old. My risk tolerances and preferences are going to be different than hers. I choose to look at my investment portfolio as my stay rich business. Whatever work I do is my get rich business. That's how I got to this place. But different families, different, so you really have to start with what the family's objectives are. Are you in the get rich business? Or are you in the stay rich business? I think for most families, they're having conversations like this. You're in the stay rich business. So you want to look at the macro outlook, have a diversified portfolio. Excuse me. And when I say diversified, it's meaningful diversification, right? You can have 20 managers, and if they're all doing the same bloody thing, you're not diversified, right? So meaningful diversification is a really important part of investing. And then I think the other things we've touched on, manager integrity, talent, access, those are all things you can figure out along the way. But I think from a family perspective, you have to start from the top down. You have to look at the macro. You want to be nimble. There are times that I'm not a big fan of CTAs. Sorry, Peter. I'm not a big fan of quant, although I raised back in the day billions of dollars for quant managers. But I always said to myself in the back of my head, models break. Right. And guess what? 2007, August taught me that. So I like things that I understand. I mean, if I could give a family any advice, if you don't understand it, don't invest. Right? Because if I can't understand it.
I think that's an interesting comment. Absolutely. It's, stick with your knitting. Biggest thing, coming from a credit point of view, and we both come from a credit background. I have never been a fan of CTA managers. I didn't understand them, etc. But I do know that at 10 to 20% of a portfolio, should the markets just tank hugely for geopolitical risks, for whatever it happens to be, they tend to outperform for the short period of time.
I like macro guys better for that than CTAs, Peter. If you were a really good macro guy.
Things about it. I will tell you something that we had a guy from Duke who was on the endowment investment committee. He said after the hedge fund crash of 2008, he said, you know what? We don't even look at hedge funds anymore. The first thing we did at Peter Plaut approach with, we look at the macro environment. We decide if we want to invest in that area. We see if there's any way that strategy has been disintermediated and we can get into it cheaper. Then only when we exhausted every cheap avenue do we get into a fund manager.
Well, by the way, I think that's a really smart point, right? First of all, everyone needs to remember hedge funds are a structure, not a strategy. very early on in my career in hedge funds, people were like, well, you're involved with this long short technology manager. Why wouldn't I just buy Fidelity's technology manager? And I was like, okay, we don't use leverage in this particular fund. The best that the Fidelity technology manager can do is rotate out of the bad sector in technology. And he's mandated to be fully invested. My guy can have 40% of the portfolio in cash. And as long as you're cool with that, it's a structure, not a strategy. And that's what people really have to remember. Forget the fees, right? The fees are about, I give you $1, how much money do I get back? And if you think about it, the smartest guys are going to want to be in a hedge fund structure because they're going to get paid more.
So I'd like to give Ellen a chance to chime in on this from her perspective.
Well, getting back to what you said, are there areas that I'm not interested in? To your point, I have sort of a Buffett approach. I was at Christie's last week and they were selling NFTs. No, it's those non-fungible, no, thank you, Joe. And then,
I'm still with you, by the way. So I get it. I'm like, I don't get it.
and then I'm sure the people that have made money in crypto are just thrilled. It's not for me. So there are areas like that if I don't feel good about what they're doing, that it's producing something or something that I feel strongly about. No, it's not an area of challenge. Because it's, as I said earlier, there's a lot of due diligence that goes into this. And if people come to me, oh, I have this great strategy in it, maybe, and they explain it for 20 minutes, I can't do that. I want to know in an elevator version, what you do, why, and why is it important? Why is it going to make money and when?
Well, let me say this about that. Part of it is that managers are sometimes really terrible at telling. I mean, I used to have a business where I would charge like a lawyer to teach people how to tell their stories. So I've been in rooms where 20 minutes later, I have no idea what the person does. And I'm like, okay, you're failing because you might have a really good strategy, but you can't explain it. So to me, there's a difference between ability to explain and my ability to understand. But I totally agree with you. If it feels opaque, I'm out.
So continuing with that, Peter, you spoke of when we had our conversation last week and the information that you sent me, you talked about the work that you do in the cannabis industry also. And so that's kind of controversial here and there. So what aspect of that industry are you working with? And do you find that there's any kind of pushback when you're speaking with families about that?
We need to be very, very clear, okay? I'm in the non-plant touching cannabis side, and it is, I'm raising capital for a particular fund there, and also a family office advising them there. So from my point of view, since we're not talking about the actual cannabis, we're talking about the picks and shovels. You go back to the gold rush, people that made the most money weren't those sifting through the soot for the gold. It was selling the picks and shovels. So we're looking at companies that are fundamentally focused on the real estate, whether it's leasing or owning. It's the technology, the SAS systems behind it. It's that type of situation rather than the cannabis. Once you get into the actual cannabis plant touching, there's a whole other issues that spring up. For instance, it's illegal on a federal level, not illegal depending on the state that you're looking at and whether it's medicinal or it's recreational or a combination thereof. We don't get involved in that. Like I said, from our point of view, I'm just investing in technology companies and real estate companies. But what you should know is that each particular state, as you know, has their own regulations. And so a pension fund and many asset managers, private equity funds and private credit funds, if their LPs are pension funds, insurance companies, et cetera, they won't be able to invest in a cannabis company because it's illegal on a federal level. So again, that's why I'm focused on the ones that are non-plant touching. So therefore you have a broader swath of LPs to deal with.
Right.
We're not effectively involved in cannabis. I mean, we may be peripherally in certain things, but I mean, I agree with what Peter was saying in terms of LP bases being able to look at it. I do believe that it's going to become more mainstream. I do believe there's a movement of people who feel like cannabis is a gateway drug to worse things, right? So if you send your 18-year-old older brother, 21-year-old older brother to go to the liquor store to buy vodka, and he could also buy you cannabis at the vodka store versus meeting the guy who sells you the cannabis and then opens up his jacket and has cocaine and other things. I don't know. But I do think it's going to be a mainstream area investment. But it's going to go through cycles like alcohol and tobacco and other controversial asset classes.
I think right now, I don't know how the whole chain works, but I don't live in New York City anymore. But from what I've read in various newspapers, they are now awarding licenses to felons, and I'm not into stuff like this until it's all gets mainstreamed and cleaned up, and so.
But I think the path is there, right? Because they are awarding licenses and there now is oversight where it was sort of a sketchy underworld business before. It's now a legitimate business. And so you do have regulators on top of it. I agree with what you're saying. It seems to me that some of these licenses, I mean, my cousin happens to be somebody who's been very involved in this in New Jersey, so I know a little bit. But it seems to me that the license that they're awarding to felons who are rehabilitated and they're giving them the opportunity to make something good out of what they did was bad. And I think they're being watched very closely. But look, we as a family are not involved. So
I think, point Peter, the CBD area is interesting. I haven't come across a company yet that is of interest to me to show to other people. But I've noticed that Harney, for example, that does teas, is now making iced tea with some kind of CBD in it. And it seems to be everywhere. So
I don't know. I think we should bring this back to the allocation conversation.
Let's go back. Just the one thing I'll just end with here is, look, we're going way off on a tangent. I'm no expert in it. I'm looking at funds that invest in the space that have portfolio companies that are strictly technology based or real estate based. So I'm looking at the companies here strictly from a traditional manager selection process. The manager selection process, if it's a cannabis company, if it's a cannabis fund, what is the underlying? Goes back to what Suzanne and I spoke about in terms of manager selection, getting granular, doing your research and due diligence. What are the companies that they're investing in? What is the government regulations? What are the fundamentals? So again, I'm looking at real estate, technology, strictly there. End of deal.
And what other non-correlated investments are you typically bringing to the families, and what is your family looking for?
So again, we focus on broad correlation, right, in the overall portfolio. So it's not necessarily what's not correlated. It's making sure the whole portfolio is not correlated on some level. And it's a mixture. I mean, I think there are very interesting things to do in one-off real estate right now. We have a manager that we use out of California called Hackman. We bought, and this is a little like, we own Silver Cup Studios in Brooklyn. We own Culver City Studios in Los Angeles, which were the assets were bought, repurposed, leased to Amazon. Hackman tends to work on one-off deals. We have long short equity, we have biotech, we have credit. I do think, and again, now I'm talking my own book, right? I think there is going to be a lot to do in $1 billion market cap companies that have bad balance sheets. Many of them have been left with those bad balance sheets because their private equity sponsors have levered them up, dividended them out, their underlying shareholders. And it is shocking how the lack of understanding that private equity sponsors have of the cap stack. And if anyone wants to talk offline, I can give examples of having conversations with private equity sponsors who are like, oh yeah, I didn't realize the bonds were at 30. And we're like, oh yeah, we have now have a blocking position. Do you want to come in and work with us, or do you want to have a donut? Up to you. So I think there's going to be a huge amount of opportunity there. And I don't think rates are coming down anytime soon. Are they going to continue to go up? there's a debate on that, right? I think we're going to see a few more hikes before we see stabilization. I don't think we're going to see cuts. And so I think you want to protect yourself from that and the inflationary risks. But in terms of lack of correlation, there's just a lot to do. You just have to look for it. That was kind of a gobbledygook answer, but
And basically that's what I do. I just come up with alternatives that I like that, as I mentioned before, you don't find them on the internet. You don't find them from your Morgan Stanley manager. They're little nuggets that are mostly early stage. And that's what I specialize in. That's
Ellen,
what's fun to me.
before we wrap up, I was hoping you could, we didn't get into allocation to VC funds in the light of SVB and others. How are you looking for your little nuggets among the VC funds, or actually little nuggets in terms of opportunities in VC? I know later on today, we're going to be talking about biosciences, opportunities, and venture capital. So I thought it might just be an interesting segue without, taking the moderator's thunder, but really just from my own point of view, want to see how you're looking at manager selection from the VC allocation point of view.
I don't necessarily go out there and look for them. People come to me, and then I have to sort through them diligently, obviously. And it depends who's recommended. I get them all the time, and I have to do a lot of homework. And I just have to feel good about it, as you said, instinct, that the things that they're beginning to put in their portfolio, or they have in their portfolio, are things that I find cutting edge. And fortunately, I have venture capital companies that have had numerous amount of unicorns. I've had people, depending on the market, have said to me, "Thank you," because everything else is, didn't do well, but the alternatives that helped to save the portfolio.
so we don't tend to do direct deals. We've made mistakes, right? We would rather find the people that we think are really good at picking potential unicorns. What we understand about venture capital is a lot of throwing spaghetti at the wall, right? And if 2 out of 20 work, that's a win. But I don't have the ability to due diligence 20. So I've got to bet on the guy that I'm betting on to do the due diligence. But I think everyone, particularly in a young family's portfolio, you have to have exposure to venture, because you will get the unicorn. And sometimes the unicorn makes up for a lot of other mistakes along the way. But my personal preference is we don't try to do it ourselves. I don't have the expertise. We don't have the expertise in-house. Our expertise is picking the guys to be the best guys at picking those venture ideas. And we do look at co-invests. We've done some that have worked. We've done some that have not, but we're very selective.
Peter, do you want to answer your own question?
Peter.
Peter?
Yeah, I'm not familiar with that whole space. So for me, it's I can't answer that, not the question, because I just not focused there.
About 5 minutes.
Okay. So one of the questions that I always like to ask is, we always talk about successes, and I think about people who go to Las Vegas or Atlantic City and they talk about how much they won at the table. They don't talk about how much they've lost or losses that they've had. So you could just very briefly talk about things that you thought were opportunities that you thought were going to be wins and turned out not to be, without getting too specific, turned out not to work out favorably for you.
Well, during the pandemic, it's been kind of difficult to close business. Do it because these are multi-million-dollar investments, and you have to really spend time with people. The clients and people that I work with, I have to know really well. I'm a big fan of, let's get together, have lunch, spend some time. I know about their family. I know what they do, what their children are up to, what their spouse or whatever. It's so I haven't, touch wood, had anything that I could say, "Oh, brother, that was a huge mistake." But I also don't handle tons of investments at a time. I I pick a few and I work on those and show them to families that I think would really benefit.
So I think in terms of like losers, I mean, again, it goes back to diversification, right? You're always going to have things that work, things that don't work, and markets are cyclical. And so you're going to have a year where your macro managers are doing really well and your long short managers are sucking wind. And, hopefully over time it evens itself out. I mean, that's really one of the reasons why we don't do a lot of direct one-off investments. When we have, they've tended to be the losers. And it's because I don't have the staff or the team or the wherewithal to stay perhaps on top of them. And then once you're in one of these private companies, you're there. You've made a bet on the front end and management doesn't come through or the market environment changes. It's not like they're tradable or fungible. So we tend to focus on being, from a family perspective, a manager of managers. And we're relying on those managers to make the right decisions. So I really can't look over, the things that we've really screwed up on, and they're never big bets because, again, we don't make big bets on these direct things. I just had something in the vaping space, right? We made an investment in a company, went bankrupt. We wrote it off, and all of a sudden now we just sold it. So it's now getting written back up. It created a whole tax situation this year, right? Happy problem to have, not complaining. But at the time I was like, I am never doing a direct deal again because this is not my expertise. I'm hiring the guys that I think are smartest in their space to do what they do best. And occasionally we'll look at a co-invest. So I can't really look over the last, we use ICG Advisors as an outsourced CIO, Jeff Asaf, if anyone knows him, based in LA. He's amazing. I work very closely with them. We just don't do directs anymore. It hasn't worked. It's not what I know how to do. It's not what he knows how to do.
Peter?
Yeah, so a couple things. My focus has always been on looking for non-correlated allocations, and that sticks to a couple things. One is non-correlated equities, non-correlated debt markets, non-correlated commodities. So I try to stick to origination of opportunities, whether that's in private credit or that's in private equity or the industries that I previously mentioned, like litigation funding, non-plant-based cannabis, et cetera. And then in terms of getting to more granular, I try to look for, we don't want to see the tail wagging the dog. So we're seeing exogenous events like we saw with SVB Bank just more recently. That's the only reason I said you should have 10 to 20% of a portfolio in a CTA manager. Not that I happen to love those, but simply from a holistic macro point of view. Then within that, I try to frame where are we going over the next 18 months. I don't see private equity outperforming. I do see private credit outperforming, particularly for those that have a more stressed, and I'm not saying distressed, but stressed background, and a team of research analysts that have lived through the cycles to be able to pick and choose. So from my point of view here, it's strictly looking non-correlated asset classes, looking for exogenous event factors that could blow up a portfolio or a manager, and do they have the diversification within them and the talent on the research side to weather the storm.
And I will just add to that for the families in the audience and online and whatever. I think if you have the ability to do work on smaller managers, as families, we don't need to be the index, right? The iConnections conference in Miami in January, there was a panel with Josh Friedman from Canyon, Mike Arrighetti from Aries, Mark Lazary from Avenue, and John Zio from Apollo. And they all sat up there and looked at each other and said, we are going to be competing against each other for the deals that are big enough for us to do, which means we're going to overpay. Right. And we know we're going to overpay, right? Josh looked at Mark and said, I might beat you out, but it means that I'm going to make less money. And so they're being very open about that. And if you're the state of Illinois, you need to have the benchmark, right? Because you don't get fired for buying IBM. But as families, I say to people all the time, you don't need the Apollos and the Canyons and I would say this in front of Josh. I'm not saying anything that I haven't said to them directly, and they're all good friends and I've known them forever. You don't need those guys. You need the smaller guys that can be more nimble, more entrepreneurial. You have to do work particularly on the back office side, as Ellen has pointed out. But the bigger guys are only going to have so many opportunities and they're going to overpay, and they admit it. So find the guys who can find the nuggets, to your point.
Any questions here before we just wrap up? Yes.
I was going to make a statement. The same thing is with hedge funds. You want to buy this sub-billion-dollar guys. Exactly.
I mean, I will say this about hedge funds. If you're looking for exposure to large cap, long, short equity, size is helpful. But yes, I agree. Smaller managers are generally more nimble and generally better. And my bias has always been towards those guys.